You always say when investors ask, what's in the crystal ball? I don't have a crystal ball, Megan. Well, you've been the first person I heard to ring the warning bell of excesses in the private credit markets. We sounded a little bit like the boy who cried wolf for years, and those predictions, those views have started to come home to roost. So for those of you who've been at this event over the years, you probably heard us talk about this going back to the 2023 forum. We did a podcast 3+ years ago warning about what we saw as excesses and concerns. So can you tell us what really led to this out of consensus view about the signs there, and maybe some historical context would be helpful as a starting point, Bryan?
Sure. I'm happy to be here, and it's good to see a lot of familiar faces. So I would just start out with that. As we looked at what we saw in the marketplace going back multiple years, it gets back to a little bit of, I like to think of things in capital cycles. So when you have a lot of capital chasing one area, what happens? Excesses occur. When excesses occur, you have lower returns, and booms will lead to bust. So that's a basic concept I've got. This is an area that grew dramatically. Direct lending is obviously it's a very long strategy. It works over time. However, if it gets overheated and it's a small market, sometimes you can have examples where excesses occur. And what we saw, we talked about software being an area of concern predominantly, and we would look at transactions that were publicly announced, and what we would see the characteristics of the cash flow or lack thereof. We saw, particularly in the software, a lot of areas where companies were EBITDA negative. They had a view that they were going to be growing dramatically, and the companies finance themselves with significant amount of debt, and they had to grow into the capital structure to basically afford the interest, and they wouldn't pay interest for a couple of years because of the way the structures were. And we thought that was inherently risky and non-traditional credit metrics. And that's what you're seeing unfold years later as companies have been given time, things haven't executed, and then there's really no one wants to put money in, and that's when the lenders have the keys turned over to them by the equity. And so that would be one example. The other piece we saw was just overall leverage levels in terms of what private lenders were willing to do may have been higher than what we would have been comfortable with in certain circumstances. And so if you look, we would see leverage, at certain transactions, we see leverage levels that could be as high as 7 times, 7 times debt to EBITDA, which is actually very, very high. That's a very common leverage level in that area on a GAAP basis. And that is something that when we compare versus the spread that you're getting, it may not correspond to the right risk reward. And so over time, we think direct lending's a good strategy. We think there'll be excess, there'll be wash out. And then there'll probably be some opportunities down the road for that.
So, one of the things we've talked a fair amount about, Bryan, is really the blurring of the markets and convergence. This actually was our topic from 3 years ago. Can you talk to us what you really mean by this? What do you mean by convergence? And how has that changed our addressable opportunity set?
So what's happened is companies have taken the approach. I think allocators are going to start taking the approach as well. Companies are taking the approach of, I don't care if it's a public, a private, a loan, or a bond. I just want to get what's the best cost of capital for me. That is the way that the companies are approaching it. And so from their perspective, it's just money. That's all it is. And so that dynamic is accelerating. And we see companies that we've invested in companies that had private solutions that have moved to a public solution. And so we've invested in that, and we've had companies where we've had public that have gone to private route because the cost of capital has been cheaper for that particular company. And so that's what we're seeing. We're seeing companies are fluidly looking at different alternatives, whatever is the best for them, makes sense. In general, what you're seeing smaller companies, a private solution is a more effective cost of capital for them. Companies, if you're going a little higher leverage points, a private solution may be a more cost-effective solution. And then you'll see a syndicated solution tends to be for companies that are a little larger and a little less levered. So that's a general rule of thumb. My own perception, my own view is over time, allocators are going to look at this and they're going to say, I don't care about the wrapper either. I just care about the returns. And what's the return stream that I am going to achieve? And I don't care if it's a loan, a bond, public or private. And I think that's ultimately where this world is headed.